How billionaires manage to pay less income tax and why the system lets them. For most Americans, tax season is a stressful annual ritual. But for billionaires, it barely registers. That's not because they've found a magical loophole. It's because the U.S. tax system is built around income, and the ultra-rich have structured their financial lives so that income barely exists for them at all. Instead of relying on wages, billionaires grow their wealth through assets like stocks, real estate, and ownership stakes in rapidly appreciating companies. And under current tax law, those forms of wealth are taxed very differently from a paycheck. A University of California, Berkeley study found that the richest Americans pay an all-in tax rate 20% lower than the median U.S. household. As Berkeley law professor Brian Gala put it, the median household effectively has a net worth of zero once debts are factored in, and yet they still pay a higher tax rate than billionaires. That's not exactly the picture of a progressive tax system. What regular Americans pay and why? Most households earn money the traditional way, such as wages or salaries. That income is taxed at progressive rates ranging from 10% to 37%. Add payroll taxes plus state and local taxes and the burden grows. Let's take a married couple earning $110,000 as example. In this example, the gross income is $110,000. Their 2025 standard deduction is $31,500, and taxable income is $78,500. For their tax calculation, the first $23,850 is taxed at 10% rate, and that equals to $2,385. The remaining $54,650 is taxed at 12% rate, and that equals to $6,558. Therefore, their total federal income tax is $8,943, with an effective tax rate, 8.13%. This is the reality for working Americans, that the taxes come out of every paycheck, automatically and consistently. Billionaires, however, don't live off paychecks, and that changes everything. Why billionaires pay so little income tax? First, they're paid in equity, not cash. Many billionaires take tiny salaries, sometimes literally $1 per year. Instead, they receive stock or ownership stakes in their companies. These assets can grow by millions or billions annually, but none of that growth is taxed unless the assets are sold. This is called the realization principle. You don't owe tax on an asset until you sell it. As Gala explains in his report How to Tax the Ultra-Rich, taxing only at realization means individuals who make most of their money through investments get to choose when to pay tax. One of these options is never. So if a billionaire's net worth jumps by $5 billion in a year, but they don't sell anything, their taxable income might be close to zero. Second, when they do sell, they pay lower rates. Investment gains are taxed at capital gains rates, which are lower than income tax rates. So even when billionaires realize gains, they often pay far less than a worker earning a salary. And third, their reported income can be shockingly low. Some of the wealthiest Americans, including Jeff Bezos, have reported taxable incomes lower than the IRS agents auditing them. ProPublica found that from 2014 to 2018, the top 25 billionaires paid an effective tax rate of just 3.4%, despite gaining more than $400 billion in wealth. The Berkeley study concluded that the richest 400 households pay an effective tax rate of 24%, while the rest of America pays 30%. Billionaires use a powerful strategy known as buy, borrow, die. This is the crown jewel of billionaire tax planning, a perfectly legal system that allows the wealthy to live lavishly while avoiding taxes almost entirely. What is the buy, borrow, die strategy? Buy, borrow, die is a wealth-building and tax avoidance strategy used by billionaires to grow their fortunes while paying little to no income or capital gains tax over their lifetimes. It works because the U.S. tax system only taxes income and realized gains, not wealth or unrealized gains. Billionaires structure their lives so they rarely have either. Let's break it down. First phase of this strategy is the buy. Billionaires don't rely on salaries. They buy assets that grow in value, such as stocks, private companies, real estate, venture investments, art and collectibles, etc. These assets can increase by millions or billions each year, but none of that growth is taxed unless the owner sells. This is the foundation to grow wealth without triggering taxable events. The second phase of this strategy is borrow. Because of their exceptional creditworthiness, billionaires enjoy access to massive credit lines and rock-bottom interest rates. To fund their lifestyles, they opt to borrow against their assets rather than sell them, a strategic move that allows them to access liquidity without triggering capital gains taxes. Why this is so powerful: 1. Since loans are not taxable income, thus borrowed money doesn't count as income, so no taxes are owed. 2. Interest rates are extremely low for the wealthy. Banks love lending to billionaires because their collateral is rock solid. 3. Interest may be tax deductible, especially when tied to investments or business activities. 4. The assets continue to grow. Billionaires don't sell the stock or real estate, it keeps appreciating. This allows billionaires to live off tax-free borrowed money while their wealth compounds untouched. This is why you'll see headlines like "Billionaire X pays $0 in income tax." The third phase of this strategy is die. When billionaires pass away, their heirs inherit the assets with a step-up in cost basis. This means all the lifetime gains are wiped clean for tax purposes. No capital gains tax ever. As Gullis summarized, they acquire their assets, they borrow money to sustain their lifestyle, and then they die without ever paying any tax. Can regular people use any of these strategies? You can't replicate billionaire tax engineering, but you can legally reduce your own tax bill using tools available to everyday Americans. Number 1 is to max out retirement accounts. Contributions reduce taxable income and grow tax deferred. Number 2 is to donate appreciated stock. You get a deduction and avoid capital gains tax. Number 3 is to use real estate deductions. Depreciation, insurance, and interest can significantly reduce taxable rental income. Number 4 is to use pass-through entities. LLCs, partnerships, and S-corp can shift income and defer taxes. Number 5 is to use harvest tax losses. Sell losing investments to offset gains elsewhere. And lastly, number 6 is to track deductible expenses. Interest, charitable giving, and business expenses all reduce taxable income. Final thoughts. The gap between how ordinary Americans are taxed and how billionaires are taxed isn't the result of a single loophole. It's the product of a tax system designed around income in an economy where the wealthiest no longer rely on income at all. Their fortunes grow through assets, not paychecks, and our laws treat those two forms of wealth very differently. For everyday workers, taxes are automatic and unavoidable. For billionaires, taxes are optional and often strategically delayed, sometimes indefinitely. The result is a system where the people with the least flexibility shoulder the most consistent burden, while those with the greatest resources can shape their financial lives to minimize what they owe. But this isn't just a story about the ultra-rich. It's also a reminder that the tax code contains tools such as retirement accounts, real estate deductions, loss harvesting, pass-through entities that regular people can use to reduce their own tax bills. You may not be able to borrow against billions in stock, but you can still take advantage of the rules that exist. Ultimately, the debate isn't about whether billionaires are breaking the law. They are not. It's about whether the law itself reflects the economic reality of modern wealth, and whether a system built for the 20th century can still deliver fairness in the 21st. Please comment below on your thoughts. I'd love to hear your perspective.